Perfect. Okay. Just a minute before 6:30 here, so just give us a moment, let people finalize joining us. We'll get ready to get started just in a moment. All right, just another moment here. I have a couple more people coming in. All right, let's get going. So first, thanks everyone for joining us this evening. Excited for tonight's topic, and also that we have a guest presenter with us, Andy Robertson from the Corporation of Social Security Claiming Strategies. So Andy actually was introduced to us also by one of our strong product partners, Athene, who we also have Mike Burgett, our partner there with us as well tonight. Before we let Andy go in and do the presentation this evening on Social Security optimization, just want to spend a moment, as we always do, and just introduce ourselves and the team that we have here. So who we are and the individuals here and who run these regular educational topics. Myself, Michael Perkins, CFP, RICP, certified financial planner, retirement income certified professional, just the one of the lead advisors and founders of our team back in 2007. Another full-time advisor, Daniel Neville, CRC, certified retirement counselor, as well as a CSSCS, which is certified Social Security claiming strategist, a designation he actually got through Andy and his company. What we tout on the designations is just the time and expertise that we put into specifically the retirement space. Who makes everything work, as well as Melissa Joyce and Cassie Foley, who do everything with us, from setting up the events like Melissa does for these webinars, seminars, educational communications out to our clients on a regular basis, and one of the lead voices you hear, and Cassie working with you on everything on the back end of things, making sure we get everything to and through the funnel, and working with you on executing upon strategies that we do. So we couldn't do it all without the team that we have. But what we do, confidently guiding you to and through retirement, is what we like to say. We got a strong team here. We have almost 50 years of experience across us, but at the same time, we are let's say, a young, energetic team that can truly get you to and through retirement. We got a lot of years left in us. I have a almost 2-year-old son, so I have many working years ahead of me. The 4 key elements of retirement planning that we like to highlight here: Social Security, Medicare, and tax planning, as well as long-term care. Tonight, we're going to talk specifically about Social Security, but we strongly believe that these key elements to this stage of life of retirement, you have to be working with experts in these areas, or how can anyone help you actually navigate this next stage and phase of life? So we cover events on all these regularly throughout the year, but specifically for Social Security, excited to have Andy with us tonight because we focus usually on Social Security maximization. And tonight we're going to talk about Social Security optimization. So I'm going to hand things over to Andy to talk with you tonight and do the presentation, but it's a switch from talking about maximizing Social Security to optimizing it for each of you with us here today. So thank you, Andy.
Great. Thank you, Michael. Thanks for the introduction and the opportunity to talk with everyone tonight. As Michael said, I'm here to talk about Social Security optimization, and just to kind of set an expectation, the difference between what I think you'll hear from me tonight, maybe what you've learned about Social Security in the past, as Michael said, is I focus on optimization versus maximization. And effectively, what that means to you is the presentation I'm going to go through tonight looks at how Social Security can impact the overall health of a retirement income plan. So rather than looking at Social Security independently of a retirement income plan, we're going to look at it holistically. And you're going to see firsthand, as I go through all the knowledge and the case study, you're going to see how taking Social Security benefits at different times can deliver, in our experience, a better, more fortified plan for significantly less capital, and ultimately solve some of the biggest concerns that people have when it comes to the overall success of their retirement income plan. So, with that said, I'm going to open with a statement that I found in a publication about 15 years ago by a financial advisor, John Ziden. And John said the fear of dying has been replaced by the fear of living too long. And I think this statement by John really captures the essence of what we're up against as a generation. And I'm not as young as Michael, so I can say that, to everybody here on this call. I'm right where you are, and I recognize this is the thing that we're up against. So we're the first generation retiring in mass, largely responsible for delivering the bulk of our retirement income from the assets we're able to save. And the ultimate concern, of course, we have is someday waking up and not having any more money. So again, that'll be the focus of what I talk about. My goal over the next 45 to 50 minutes will be to put you in a position where you're far better off from an understanding perspective as it relates to Social Security than you were when we started tonight. So if I do that for you and I do it successfully, I'll love to hear about it in the end. And ultimately, we'll talk about how you can take advantage of some of the things we talk about from a planning perspective and do that through Michael and his team because they are truly retirement income specialists in a world of generalists. I can say firsthand that they are specialists, and you saw that in their opening commentary where they talk about the building blocks of retirement income planning. I work with financial advisors all over the country. We've had thousands of financial advisors matriculate through our course. Very few are truly specialists, but Michael and the team fit that moniker, and the work they do is profoundly impactful, as you'll see on the retirement income plans they build. So when we talk about Social Security, I just want to be clear to start out. I'm going to talk about Social Security, what I'll call fundamentals, just so I know we're all on the same page. But what we're talking about tonight is more commonly known as the Old Age Survivor and Disability Insurance Program. So you'll all remember when we used to get actual hard copy pay stubs and you used to see as a deduction OASDI. That was the deduction for the Social Security retirement system. And Social Security, when it was first introduced, as you well know, was introduced as a tool to keep the elderly and the sick out of poverty, hence the name, the Old Age Survivor and Disability Insurance Program. Today, it's the primary income source for certainly 76 million boomers and obviously future generations as well. So, Social Security's mission and the role it plays has changed dramatically. Being able to understand all the ways it can impact the plan and leverage all the benefits it offers is critical to building the ultimate plan that you're looking for. Now, to qualify for Social Security benefits, a worker must accumulate what's known as 40 credits. So you'll hear people talk in terms of 40 quarters. Once you have 40 quarters, you're fully insured. The reality is, and technically speaking, once you have 40 credits, the soonest you can accumulate 40 credits is 40 quarters. You earn a credit for every quarter in which your earned income surpasses what Social Security calls their earnings requirement. So that they call it substantial earnings requirement. So every quarter that your earned income surpasses that number, you earn a credit. The soonest you could accumulate 40 credits and be fully insured is 40 quarters, obviously. So 10 years, and people will talk about it in those terms, but it's actually 40 credits. So it could take longer, but more often than not, people attain full retirement, or pardon me, fully insured status after 10 years. Now, once you're insured, you have a lot of options when it comes to retirement, but I'm going to focus on three. I'm going to focus on taking benefits early and talk about how early you can take benefits, waiting to take benefits until full retirement age, and then delaying benefits. And what's the implications of each when it comes to your Social Security benefit calculation? So, for the purposes of our conversation, I'm going to assume that everybody tonight on this call has a full retirement age of 67. So, if you have a full retirement age of 67 and you opt to take benefits, retirement income benefits now specifically, if you opt to take benefits as early as possible, age 62, you're going to incur a reduction in your benefit value. That's a 30% reduction if you have an FRA of 67, and that reduction is for life. And keep in mind, we'll talk about this more later, the higher of the two Social Security benefits in any household where you have two spouses, the higher of the two benefits is going to continue for the life of the surviving spouse, right? So that 30% reduction may not be just for your life, it may be for the life of your surviving spouse as well. Now, you don't have to take early, but if you do and you take as early as possible, the reduction again is 30% and it's permanent. You can delay, of course, but before you delay, you can say, well, you can delay beyond 62. You can wait all the way till full retirement age. So again, I'm going to assume everybody on tonight's call has a full retirement age of 67. It's been a bit of a moving target here the last dozen years or so because when people ultimately were born, the year they were born dictates what full retirement age is for them. And people who were born in 1954, it was 66. If you were born after 54, every year after you add 2 months. Ultimately, if you were born in 1960 or later, it's 67. So over the last few years, we've kind of been evolving to this 67 number. But I'm going to guess again, most of you on the call tonight have a full retirement age of 67. So what does that mean? That means if I opt not to take early at 62 and I wait all the way to full retirement age, I will receive my entire what's known as my primary insurance amount or PIA. So that primary insurance amount is my retirement income benefit at full retirement age. That number, by the way, not only dictates what I'm going to get paid, but it also dictates what any people who may also, what I'll call dependents, may also be entitled to on my earnings record. So the PIA is a very important number to know in your Social Security world. 67, your retirement income benefit at 67 is your PIA. If you take it 62, that number is reduced by 30%. If you delay beyond full retirement age, you can get more than your primary insurance amount. How much more depends on how long you delay. So delayed retirement credits are like FRA. They're predicated on the year in which you were born. If you were born after 1943, I'm guessing that's the case for everybody on tonight's call, then your delayed retirement credit is 8% per year. So here's what that means. For every year you delay, you can accumulate 8% more on top of your primary insurance amount via delayed retirement credits. If you have an FRA, full retirement age of 67, and you delay till 70, you're looking at a 24% increase at 67 minimum over what you would have gotten had you taken benefits at 70 over what you would have gotten had you taken benefits at 67. So I'll say it again, just so I'm clear. What you can receive at 70, thanks to delayed retirement credits, is 24% more than you can receive at 67. That's a minimum. It cannot be less. It could be more. I'm going to talk about that later. But you don't want to wait beyond 70, just so we're clear, because delayed retirement credits stop accumulating once you attain age 70. So while it may be attractive to earn an additional 8% per year, don't wait beyond 70. There's no value to waiting once you attain 70. Now, to kind of bring all this together, what I'm going to do is talk a little bit about what I call the lifespan of a primary insurance amount. I want you to see how benefits are impacted on a year by year basis. So what you see here is we have somebody with a primary insurance amount of $1,000, a nice simple round number we can all wrap our heads around. And I want you to see what happens if you take benefits not at 67, but at 66, and then 65, and 64, 63, 62, and so on. And what ultimately is happening operationally behind the scenes is for every month you opt to take benefits prior to full retirement age, there's a fractional reduction in your benefit calculation. Ultimately, as we talked about, if you opt to take as early as possible, 62, that reduction is 30%. Conversely, if you opt not to take early, you don't take it full retirement age and you delay, it's a fractional increase for every month you delay, equivalent to 8% per year. It's important to note that that 8% is a simple interest calculation, and that's because the actual delayed retirement credits are not applied to your benefit calculation until you file. So there's no opportunity for compounding. So unlike a bank account where you may put money in a CD, not anymore, but there was a time you could put money in a CD and get 8%, right? And at the end of the year, they add 8% to your account, and then next year you're in 8% on that same thousand plus the 8% from the year before. They call that compounding. No compounding here because they don't actually apply the increase until you file. So it's an 8% simple increase. But what I really like to talk about is what are the differences between what I can receive at 62 and what I can get at 70. So most folks are kind of, not kind of, but they're fully aware of what the impact is for taking early, 30% reduction. And they know more often than not, they know if they delay beyond 67, they'll get more. But they're not real clear on what is the actual difference in Social Security benefits between 62 and 70 minimum. If I have a PI, if I have a full retirement age of 67, what's the maximum, pardon me, the minimum increase I can get between 62 and 70? And it's a 77% increase. And I bring that to your attention because I think a lot of people don't understand just how impactful that 77% increase can be to the overall health of the plan. This will be one of the backbones of what we talk about tonight. But the other thing I'll share is that 77%, that's a minimum increase. It cannot be less, but it could be more. And you'll see that as we get further into the presentation. Now, I'm going to go away from increases in benefits for a minute. And I want to talk about something that, from my experience, there's a lot of confusion around. That's spousal benefits. So within the Social Security retirement system, there are a number of different benefits that you'll hear about, but two that I think people kind of conflate and get confused by are spousal benefits and survivor benefits. So spousal benefits are what I refer to as living benefits. Spousal benefits are benefits that are added to another benefit. They're not in replacement of another benefit. So when you have two spouses, there's an opportunity that if one spouse's benefit is worth less than half of the other spouse's benefit, the spouse with the smaller benefit can see an increase in their overall monthly payment thanks to what's known as the spousal benefit or the spousal excess. So there's a lot here, but I'm going to get right to the math. I think the math really kind of drives the point home. Let's say, for example, we have two spouses, and spouse one has a primary insurance amount of $2,400 a month, and spouse two has a primary insurance amount of $1,000. To determine if either spouse is entitled to an excess spousal benefit, Social Security will first take the higher of the two benefits and they'll cut it in half, just like you're seeing here. They'll take that outcome, $1,200 in this case, and compare it to all of the smaller benefit, which is $1,000. Any difference is going to be added to the smaller check in what's known as an excess spousal benefit. So together, the two spouses now have the ability to not just get $2,400 for spouse one, but spouse two is going to get $1,200 in total. A single check for $1,200 that's comprised of two parts. $1,000 in my example from their own work history, and another $200 provided as an excess spousal benefit to bring them to 50% of spouse one's benefit. So together, they have $3,600 on a monthly basis. Now, what I want you to understand about spousal benefits is in order for a spousal benefit to be payable, you only have to have one fully insured spouse. So let's pretend for a minute, given what we just learned, let's pretend for a minute only spouse one was fully insured, meaning only spouse one was entitled to a benefit. Let's say spouse two stayed home, raised 5 kids like at my house, had a lot of time out of the workforce, and by the time they retired, they weren't fully insured. How would it play out? Well, it would work the very same way. They'd take half of the higher benefit and subtract all the smaller benefits. So in my second example, this would be a zero, pardon me, and now the spousal benefit would be $1,200. The point I'm making is in any household, there aren't many rules of thumb when it comes to Social Security, but in any household where you have one fully insured spouse, that household is going to be entitled to at least at full retirement age 1.5 times that benefit. So, like I said, Social Security highly complex. To give you some perspective, 2,728 filing rules, over 500 possible filing combinations. Very difficult to put your finger on a rule of thumb. This is one you can take to the bank. In any instance, we have one fully insured spouse, they're going to have at least 1.5 times that benefit. So that's the power of spousal benefits, and that's a living benefit, right, that gets paid while you're together. Now, let's talk about what Social Security refers to as independently entitled divorced spouses. So we've got spouses that are married, and then we have spouses who are divorced. Under the independently entitled divorce rules, you can still collect a spousal benefit so long as you meet the criteria of an independently entitled divorced spouse. So think about everything we just talked about in terms of benefit calculations. And if you're divorced, but you were married for at least 10 years to your prior spouse, you've been divorced for at least 2 years, you're currently at least 62, not married, the math works out. All of your primary insurance amount is worth less than half of your spouse's primary insurance amount, and your former spouse is at least what's known as entitled, meaning they're at least 62. They don't have to be collecting, they just have to be entitled. If this is you and you meet this criteria and you see the numbers I just went through, you can collect an excess spousal benefit from your former spouse even though you're no longer married. So the words kind of say it all, which is not always the case in Social Security, but independently entitled is the key. So because you were married for 10, divorced for 2, you now reserve a right as an independently entitled divorced spouse to tap into your former spouse's benefit and collect a spousal benefit if the math works out. And by the way, they don't have to know about it. They're not told about it. It does not impact what's known as the family max. So it cannot hurt any of their current or future dependents. And in order to actually tap into a spousal benefit as an independently entitled divorced spouse, you simply make an appointment at a local field office. You need to know, obviously, your former spouse's name, social security number, bring evidence of marriage, like a marriage license, and evidence of divorce, like a divorce decree. Those two legal documents will establish the two timelines of 10 years, or that it'll establish the timeline so that you can meet the 10-year and 2-year requirements. The only other piece of information you need is the mother's maiden name, your former spouse's mother's maiden name. Armed with that information, not only will they tell you exactly what you're entitled to, but they'll help you tap into it. And again, there is no notification made to your former spouse. So if this is you and you believe you're independently entitled, make sure you talk with Michael and the team about this and make sure you take advantage of the opportunities that are there. Don't miss out simply because you didn't realize you couldn't act. Take advantage of that today. Now, we talked about spousal benefits, and I referred to those as living benefits. Then we have what I'll call death benefits or survivor benefits. And if I'm an independently entitled divorced spouse, I meet that criteria. Once again, even though I'm no longer married to that person, I still can tap into their benefit as a survivor benefit. So remember, under the spousal benefit, what I can get is up to half of their benefit. As a survivor, I can get their whole benefit. Okay, so as a widow, I can collect their whole benefit. So what does it take? Slightly different. What does it take to be considered an independently entitled divorced spouse for the purposes of survivor benefits? I have to have been married for 10 years, divorced, divorced for 2 years. But now, one caveat here is I only have to be 60. I don't have to be 62. So you can collect the survivor benefit 2 years earlier than a retirement income benefit, or 12 years earlier at age 50 if you're fully disabled. So 60 if it's a survivor benefit rather than 62 for a retirement benefit, and 50 for a survivor benefit if you're disabled. The other caveat here is in order to collect, you do not have to be unmarried. So you remember talking about independently entitled divorced spouse for the purposes of spousal benefits, you had to be unmarried at the time you filed to collect a spousal benefit from your former spouse. Not the case for a survivor benefit. You can be remarried. You just simply, and I don't know why, these are some of the things that Social Security's decided, but you just simply cannot have married your current spouse prior to age 60. So what does all this mean? So if I'm an independently entitled divorced spouse, but I've remarried after age 60, and both spouses, former and current spouse, pass away, I can collect the survivor benefit from either one. Or if my former spouse passes away first, I can collect the survivor benefit at 60 from them. And then later, if my current spouse passes away and that benefit's more advantageous to me, I can drop the first one from my former spouse and pick up the current one from my current spouse. So the point I try and illustrate here is there's a lot of opportunity for everyone, not just those who are married, also those who are formerly married, or even even those who are formerly married and now remarried. So the story I'll tell you very quickly is we met a woman here in Massachusetts. I'm in Massachusetts as well. This is about a dozen years ago, who came to us looking for help. She had been married for about 30 years, raised a family, never worked outside of the home, got divorced in her late 50s, met all the criteria of an independently entitled divorced spouse. In her late 50s, she met another man who was a lifetime Massachusetts state employee. When they met, he was already retired. He had, under the pension option, he selected option A, which I'm sure Michael and the team know is 80%. There's no survivor benefit. He never paid into Social Security on his earnings as a state worker because they don't in Massachusetts. So he was not eligible for Social Security. By the time they meet, he's already collecting his 80% pension. He has no Social Security. They end up getting married. She marries him literally 59 and 11 months. And as a result, she forfeited her rights as an independently entitled divorced spouse under the survivor benefits. Her former husband passed away. She went to collect a survivor benefit and discovered at that time she was no longer independently entitled. She was dependently entitled on her new spouse. And she learned the hard way that there'd be nothing left for her if something happened to him. No survivor benefit on the pension, no Social Security. And if she had simply sought out the advice of counsel before she made that decision to remarry, 1 month and she would have preserved her rights as an independently entitled divorced spouse. So if that's you, make sure you consult with the proper professionals before you pull the trigger on when you put your entitlements at jeopardy over your marital status. Okay, so moving on. When do people historically take Social Security benefits? So I have the statistics up for you. It's not a trick question. Ultimately, what we see is people have historically taken benefits early. I'm sure Michael and the team can attest that when we ask people, why are you so convinced you should take benefits early? We get a whole host of answers, but most of them kind of are in and around this idea that, well, I know I can get more if I wait, but I'm not convinced I'll be here. I know if I wait till 70, I'll get more, but I'm not convinced I'm going to make it till 70. I don't know if Social Security will be here. I'm going to take benefits early because I don't want to make the wrong bet. And whether anybody kind of phrases it that way or not, that's really what's on their mind. And the wrong bet would be this: opting not to take benefits at 62, waiting all the way instead till 70, knowing you're going to get at least 77% more. And then on your 364th day of your 69th year, you slip and fall off a 1,000-foot cliff. And all you can think about on the way down is, oh crap, I should have taken Social Security at 62, right? Because I just left all of that cash flow on the table. That's the bet no one wants to make. They don't want to miss out. And while I get that, I think people don't understand the opportunity cost of taking early, meaning what am I giving up at the same time? I know what I'm risking if I wait, but what am I giving up if I don't wait? And that's what we'll talk about next. But ultimately what I've seen is the driver of the decision is not some deep level quantitative analysis. Maybe they do what I'll call a back of the napkin mathematical equation, and they focus on this concept of break even, which I think you don't need a financial advisor to help you walk through break even. You can kind of all do it yourselves. But beyond that, I really think the driver is I don't want to make the wrong bet. I don't want to end up being that person that waited and didn't get ultimately what I'm entitled to. So, what's the alternative? I don't know about the folks on the call tonight, but for a lot of the people we meet, what they're thinking about doing before they get fully informed is basically employing a hedging strategy that they've come up with. So they're going to take benefits early, but instead of burning all that cash, they're going to take the benefits early. They're going to keep working. They're going to save every check. And in their minds, they're saying, this way, if I slip and fall off that cliff like Andy's talking about, I die with a smile on my face knowing I didn't leave a dollar on the table. And if I live a long time, well, I'll use this secondary retirement account I built by saving all those checks to match that 77% increase Andy was talking about. And that's what I want to focus on next, because what I'll say is like a lot of things in financial planning, that sounds really good in theory, right? But in practice, what you're going to find is there's some real challenges to executing that hedging strategy. And the first challenge you'll come across is what's known as the earnings test. So, what the earnings test says, simply put, is if you are under full retirement age, so 67 for this group, you opt to take Social Security benefits early, and you keep working. If you have earned income, not unearned income, and I want to delineate, not investment income, not income from rental properties, not pension income, right? Not lottery income. If you have earned income from gainful employment, and that earned income in 2025 surpasses $23,400, for every $2 you're over that threshold, you're going to be forced to forfeit a dollar in Social Security benefits. So why do I bring this up? Well, if your plan, if your hedging strategy is to take benefits early, save every check, and of course the reason you'll be able to save every check is you're going to keep working, it's going to be difficult to execute that strategy if, unbeknownst to you, those checks never come, right? And how would that happen? Well, let's look at a simple scenario. Let's say you earn $71,400 in retirement. That puts you over the threshold in 2025, the 23.4 threshold, by $48,000. And if you're required to forfeit a dollar for every $2 you're over, we simply divide the 48,000 by 2 to arrive at the forfeiture requirement. You're going to be required to forfeit $24,000 in benefits that first year. And because you have a full retirement age of 67, you would have 4 full years where you were at this, what I'll call lower 2-to-1 threshold. So between 62 and 66, in my example, you would forfeit $96,000 in benefits. Going to be pretty difficult to execute that hedging strategy if you don't get your hands on $96,000 worth of Social Security income. Okay, so that's the first kind of hurdle you're going to come across, and why I say sounds good in theory, but it can be a challenge in practice. The other thing that's worth noting is the income level that they utilize to determine if you're over the threshold is your gross income. So many of you, I know, like me and others that I know, we're just coming off the back end of getting our kids through college, and we're finally back to saving for retirement. We're taking advantage of all those catch-up provisions in our employer-sponsored 401k plans or 403b plans, and we're thinking, well, that's okay. I make 50,000, but I put $30,000 in my 401k plan. The IRS does not consider your net, right, after deductions into an employer-sponsored plan. They're looking at your gross. So if you make 71.4 gross, regardless of how much you defer through your 401k, they're going to look at all 71.4 versus the threshold in this case of 23.4. So big challenge, big problem to accomplishing your objective. The earnings test, it goes away at full retirement age, right? Once you attain age 67, you can make all the money in the world, no reduction. But from 62 to 70, you could, in my example, forfeit $96,000 in checks. Going to be really difficult to execute that strategy. Now, I'm going to come back to that, but the next thing I want to talk about is why the fixation on Social Security. So what you'll find is a lot of financial professionals really don't delve into Social Security, and there's a number of different reasons for that, not the least of which is it's highly complex, number one, and number two, they feel as though they don't get paid. But true retirement income specialists recognize this is an incredibly important tool that I cannot ignore and that I have to quantify in the overall retirement income plan. That's why we would classify those people as retirement income specialists. But what it is specifically about Social Security that makes it so powerful as a planning tool is number one, like we talked about, the income is guaranteed, right? Number two, whether you know it or not, it's highly tax efficient, and we're going to talk about that. And number three, in spite of what the media tells you, it's automatically inflation adjusted. So when you think about the risks you're up against when you're building a retirement plan, the only risk we're really missing here is market volatility, right? If we kind of stacked, the biggest risks that Michael and the team are trying to manage through and around for you, it's the risk of inflation and taxes, and arguably the biggest threat, longevity, because it's a risk multiplier, coupled with the underlying market volatility you inevitably experience. You have four of the biggest challenges you can face. Social Security truly, as an income source, combats the erosive effects of all three: longevity, inflation, and taxes, as it relates to the income that Social Security brings to the plan. So, for instance, the income that Social Security is providing is automatically inflation adjusted. If Social Security did not provide that inflation adjustment, did not provide you with an 8.7% increase a couple of years ago to help keep your purchasing power in place, where would that adjustment on your fixed income in retirement have to have come from if not for Social Security? It would have had to come from the capital that you've been able to accumulate, which poses more risk, more threat, right? So more tax efficient, as we'll talk about. So ultimately, this, in my opinion, Social Security is the most dynamic tool in the retirement income planning toolbox, and I'm going to put that on display for you as we get a little further into this presentation. So, next thing I want to focus on is the messaging around retirement. So, I've been in the retirement planning business in one capacity or another for going on 36 years. When I started in this industry in 1990, we was going through this massive transition of traditional pension plans, away from traditional pension plans, and into what they call defined contribution plans, or more commonly known as 401k plans. And if you were around during those times, and I'm sure maybe Michael's team wasn't all in the business at that point, but most of you were working and contributing to plans, there was a lot of enthusiasm around this new 401k phenomenon. We were putting money in, the employer was matching, the market during the 90s was delivering double-digit returns like clockwork, and there was no question about whether or not you'd be a multi-millionaire in retirement or a millionaire in retirement. The only question you had in your mind was how many times over, right? Because the dynamics of what we're experiencing was incredible. And it was incredible for a while, and then things changed, right? The market no longer performed like it performed originally. Employers, in the need to increase profits and cut costs, stopped matching the way they did before, right? And all of a sudden we wake up and here we are, 35, 36 years later, and all the enthusiasm around 401ks has kind of petered out. And now the messaging around retirement is fear, right? The message that you're hearing on a daily basis is you are, as a society, crummy savers, Americans that is, and the vast majority of you are not on pace to meet your retirement savings targets. And I share this statistic with you from the National Institute on Retirement Security. It's a think tank in DC. They redo this research every few years. Their last their last outcome said 77% of Americans were not on pace to meet their retirement savings targets. Fancy way of saying 77% of Americans were going to be underfunded when the time came to pull the trigger and move from their work years to their income or retirement years. What no one talks about is virtually every one of these research projects that's giving us this kind of negative result assumes everybody's going to take Social Security benefits early, which is great, in my opinion, because that's where the opportunity lies for a team like Michael's team and an organization like mine. We're going to dig into Social Security rather than just assume what you think you should do is the only thing you should do. And we're going to show you through education how actually Social Security is the one last opportunity many of you have to make sure you end up on the best side of this equation, the 23% that are fully funded. And what you're going to learn, if I do my job correctly, is more often than not, it really isn't a saving issue. It's a planning issue. It's a knowledge issue, right? It's who am I working with issue. That's the challenge that can be overcome. And Social Security, in many instances, is the one last opportunity you have as a retiree to save what, whether you realize it or not, what may otherwise be a doomed retirement income plan. So that's the next phase of what we're going to talk about. We've kind of covered the basics. We've talked about how benefits are built. Now we're going to focus on how does taking Social Security benefits at different times impact the overall health of my plan. And remember, I talked about it a minute ago, but for many of you, because pensions are by and large no longer around, this is the one. Social Security is the one source of income you'll have that's guaranteed and paid for life. The higher of the two benefits is continued for the life of the surviving spouse. It's automatically inflation adjusted. There are very few pensions around at all, and there are even less that provide an inflation adjustment. It's highly tax efficient. And then, unlike some of the financial institutions we learned in 2008 with too big to fail, Social Security is backed by a government promise. So I'm going to take a minute and just talk about that for a second. Every election cycle, without fail, Social Security becomes a hot topic, right? And everybody wants to talk about how they're going to fix it. I believe, having focused on Social Security almost exclusively for the last, call it 15 years, it is truly a political football. When people ask me, what do you think is going to happen? I say, here's what I think. I think when you apply common sense to all the concerns that are being raised, you come up with a different conclusion. So Social Security is the primary income source, right? Represents 50% of the income for 76 million boomers alone. Just think about the boomer generation alone. Primary income source for 76 million boomers. And the fear, of course, that's being stoked is we're all going to wake up tomorrow, and in the middle of the night, Congress is going to enact some legislation that not only, never mind, reduces what we're going to receive from Social Security, they're going to just pull the rug out from Social Security altogether, right? And our benefits are going to stop coming. Well, ask yourself this question. If Congress took away the 50% of the purchasing power from 76 million boomers, and they did it tonight, what kind of an impact would that have on the American economy beginning tomorrow morning? All of that consumption power removed from the market overnight, it's not an option. That's the simple answer. Regardless of what you're hearing, it's not an option. That's the answer that I'll give to anybody who asks. The other thing I'll tell you is there are a number of very simple and effective ways to fortify Social Security. The bills that can get that done have been floating around Capitol Hill now since I've been in this space exclusively, and the simplest one is to raise the cap. The other thing, and that will happen in my estimation, the other thing I'll share with you as it relates to, what do I think about Social Security and what's going to happen and so on and so forth. The term insolvent gets thrown around, but it's a misrepresentation of what we're up against. If Social Security does nothing between now and call it 2035, what they're saying is from that point going forward, whatever the benefit is that you're receiving or would have received is going to be reduced by 25%. Insolvent, look up the definition for yourself, says can't pay your bills. This is totally different. But more importantly, what I think people get hung up on is I'm going to take benefits early. I'm going to incur that 30% reduction for life because I'm afraid of getting a pay cut. I think about it differently. First off, I don't think it's even feasible for the reasons I mentioned, number one. But number two, if you told me today I was guaranteed to get a 25% pay cut, I'd be thinking, okay, so I'm keeping 75% of whatever I do get. So with that as the backdrop, I'd rather keep 75% of a 77% larger number, right, than 75% of a 30% smaller number. So I would argue that that's not another reason to take early. That's another reason that you should consider delaying. Think about it's not what you spend, so to speak, like taxes, it's about what you keep. If I knew I was going to get 75% of a 77% larger number, you could never convince me that I should take early and take a 30% reduction, knowing I was about to incur a 25% reduction in that payout. So these are things that Michael and the team can certainly address in person, but hopefully I've given you something to think about as it relates to Social Security and ultimately whether or not it's going to be there for this generation in the capacity that it's constructed now. So moving on, I want to talk about this hedging strategy. I want to go back to the hedging strategy that we talked about earlier, and I want to talk about um, ultimately what people are thinking, right? So aside from the fact that they don't understand the earnings test, let's pretend the earnings test didn't exist. What they're really thinking is, I'm going to take benefits early. I'm going to save every check as if they have the intestinal fortitude to do that, right? I'm not going to spend any of it. And I'm going to save all that money. And if I'm still here at 70, I'll have all that capital to deliver the increase, the 77% increase Andy was talking about would have gotten had I simply waited. Okay. Well, again, pretending the earnings test doesn't exist to make the math easy, let's kind of put this theory to the test and try and understand, what do I have to earn in market performance to accumulate enough wealth between 62 and 70 to make that a reality, right? So to show you how much of a challenge that is, I'm going to use a quick fact pattern here, a case study. So let's say we have two spouses whose primary insurance amounts of 3,200 and 2,800 independently, and together it's 6,000. They're the exact same age, and they say, let's take it 62, take the 30% reduction, we'll take the 4,200, but we'll save it like clockwork, right? We'll save it like clockwork, $4,200 a month for the next 96 months. And I'm betting we'll have enough money 96 months from now to match the increase Andy's talking about. Well, let's see. Let's be clear on what the increase is. 77% more, pardon me, is means it's 70. I'm going to get 7440 rather than 4200. So that's 3240 more per month, right? It's 70 for this couple, then they're going to get it's 62. So I hope everybody's with me on that. So I've got to have a big enough pile of cash by the time I hit 70 to deliver an additional 3240 a month, right? So that when I add that to the 4200 they've been getting, they're getting in total the same 7440. Well, 3240 a month is $38,880 a year. And I'm venturing to guess you recognize that's a big number, right? That's a large amount of income we've got to generate from this so-called capital we're going to accumulate. So to determine first how much capital we'll need, and then from there back into what kind of an investment return will we have to get on that $4,200 a month to achieve that level of savings, we have to use what I'll call some kind of a credible approach to arriving at that number. So I use what's known as initial safe withdrawal rates to back into the capital requirement. The number most commonly referred to as the 4% safe max. You can look it up for yourselves. 4% safe max was introduced to the industry in around 1992. And ultimately, what the research indicated was I can take 4% from my portfolio, increase it to combat inflation every year, and have an 80% chance that 30 years from now, I'd be able to make that last payment, right? It would be fully funded. I'd be able to make that last payment. So, couple things. The 4%, what a lot of people don't realize is that 4% distribution amount or initial safe withdrawal rate is what's known as a gross number, right? So, the research that was conducted, the Bengen study, made no assumption for fees. So 4% is the maximum amount of pressure the portfolio could withstand, inclusive of fees, number one. And number two, they sought to achieve an 80% probability of success. In our software that I've developed and Michael and the team have access to, we let you decide, the consumer, what do you want your probability of success to be? You pick anywhere from 50% to 99%. I can tell you no consumer has ever picked 80% as their target, as their benchmark. Everybody picks 90, 95, more often than not 99. So we make an adjustment to this 4% number to account for both the fees and the increase in desired probability. And we do that so we can get to an accurate number of what is the net in your pocket initial safe withdrawal rate, because I need to know how much capital I need to put $38,880 of additional income in your pocket at 70. And when I back into that initial safe withdrawal rate, net out fees and net out the reduction for the increase in desired probability, I have a net in your pocket initial safe withdrawal rate of not 4, but 2.62. So how much capital do I need to deliver 38,880? I need just shy of $1.5 million. So what this equation is saying, real simply, is $38,880 is 2.62% of what number, right? And the answer is $1,483,969. Now, here's the thing. If you did some back of the napkin math, you took 4,800 and multiplied it by 96, you're not coming anywhere near close to $1.5 million. So how do you get there? if the 4,200 is saving the 4,200 alone, right? Forgetting the earnings test is there. If you saved it all, how do you get to that 1,500,000? You have to invest it. You have to invest it aggressively enough to earn. You ready? Almost 34% per year in a compounding annual growth rate. And if you're lucky enough to generate that kind of a return, and that's all you'd have the $1.48 million you need to do what? Match what you would have gotten automatically had you simply waited. So I share this with you to demonstrate the economic value that Social Security brings to the overall retirement income plan that you cannot account for in something like a break-even analysis. So this is the power of Social Security. This is the cash equivalent of waiting, and it's not something you can easily match. I think Michael would agree. There's never been a period of time, any 8 year period of time in the market, especially where you'd have to build a portfolio that had some kind of balance to it at that age, where you'd get a 34% return. Just hasn't happened. Now, on top of that, that was to match a 77% increase. You'll remember when I talked about the difference between 62 and 70 being 77%, I said that's a minimum increase. It cannot be less, but it could be more. So, of course, the question everybody wants to know is how could it be more? And here's how. Once you reach what's known as your first year of entitlement, age 62, whether you begin collecting Social Security benefits or not, that primary insurance amount I talked about earlier, right? Your benefit value at 67. Every year a cost of living adjustment is declared. Whether you're taking benefits or not, that primary insurance amount is adjusted on a compounded basis to account for the cost of living adjustment. And I want to say that again, whether you're collecting or not, right? So what does that mean? Because some of you may have said, oh, he didn't account for cost of living adjustments when he did the numbers between 62 and 70. Well, I did, but I don't have to on the Social Security part because it automatically inflation adjusts itself, right? But the ultimate increase is determined at 70 when we can see what the COLAs were each year between 62 and 70. So the only way I would get just 77% is if not a single cost of living adjustment was declared between the time in which I attained 62 and the year in which I attained age 70. That would mean all those years, no COLA. There's only been 3 times in the history of COLA since they became automatic that it was a zero, and only 1 time where it happened in consecutive years. So the odds that you would have all those years and no COLA, how about slim to none? And every year I go back and I say, all right, well, what happened in the last cycle? So what were the actual cost of living adjustments that were declared, and how did it impact that 77%? So let's say we meet, it's January 1st, 2017, and you attain age 62 on that day. And you say, Andy, if I wait, I know I'm going to get more. How much more am I going to get? And I say, you're going to get 77% more. Cannot be less, but it could be more. You come back January 1st, 2025. What was the actual increase after the cost of living adjustments have been applied to the primary insurance amount each year? And then remember the 24% delayed retirement credits gets added on top at the end. What was the actual increase? Not 77%. You got it, 133%. And I'm not cherry picking these numbers, right, to show you something that's unattainable. This is the last cycle. I update this every year. And whatever the numbers are, that's what the numbers are. But right now, the actual increase, had you waited, would have been 133%, not 77%. Now, keep in mind, you had to earn, assuming you could avoid the earnings test, you still had to earn 34% in the market on your capital to match a 77% increase. I think we can all agree that's highly improbable. What's the likelihood you're going to match a 133% increase? It's not even a consideration, right? We're not even going to have a conversation about it. So this is the power of waiting, and where it manifests itself for you is in the amount of capital you have to save in order for your plan to be fully funded, in order for you to meet your retirement income planning objectives. So, kind of carrying on here tonight. Maybe I had too much coffee before the call, but we need about another 10 minutes, Michael. Is that all right to wrap this up and to do it right? Okay. So, kind of putting this all to work, we're going to look at a case study. Again, building on what we've seen. So, we've got a married couple, and they're both age 67 now. They didn't take benefits early because of the earnings test, but now they're at 67. They're saying, all right, we want to know how much capital are we going to need to have in order to meet our plan's objectives. Our plan's objectives are we want $108,000 of total income before taxes. We want it to last for 30 years, and we have a desired probability of success of 99%, meaning we don't want this plan to fail, right? We don't want to lose sleep at night. We've together saved $1.2 million. Do we have enough at $1.2 million for us to meet our objectives, 108,000 over 30 years with a 99% desired probability of success if we take benefits at 67? Again, using those same primary insurance amounts, 3,200 and 2,800, together would be 6,000. If they take it 67, Social Security is going to provide $72,000. So we're going to look at this scenario. We're going to call that the earlies. Taking it 67, we'll call the earlies. We know Social Security is going to provide 72 out of the $108,000 income goal that they have. And then we're going to say, what if they delayed? What if they took later at 70 and forget COLAs for a minute? They simply got the 24% increase from 67 to 70, right? Remember, the 77% increase I speak about is between 62 and 70. The increase from 67 to 70 is 24%. So we're going to figure out real quick whether or not 1.2 million is enough money by using the same what I call credible quantitative approach that I used earlier to figure out how much capital do we need to match the 77% increase. But to do that, we first have to establish how much of the total income has to come from assets versus Social Security. So for the earlies, we subtract 72,000 in Social Security. We need 36,000 from the assets. For the laters, we subtract the increased Social Security benefit thanks to delayed retirement credits. We need less money from the assets. What do we need in capital to make it a reality? Well, for the earlies, they need $36,000, and the initial safe withdrawal rate, because when I talked about the initial safe withdrawal rate a moment ago, I was talking about turning benefits on, if you remember, at 70. So the initial safe withdrawal rate was 2.62. But if we take benefits 3 years earlier, the initial safe withdrawal rate is lower because we're adding 3 years to the overall plan. So the earlies have a $36,000 goal that they have to fill from the capital, 2.4% net in your pocket initial safe withdrawal rate. They need $1.5 million. They don't have 1.5 million. They have 1.2 million, which means they land on the same side of the equation as everybody else. Even though they've accumulated what many would perceive to be a lot of money, they're still one of the 77% that is underfunded. So what are their options historically? Well, they could delay retirement, right? They could save more money. They could reduce their income expectations in retirement. Maybe they would think it's a good idea to take more risk in their retirement income portfolio, which most people would advise against, right? The other thing and the most frequent solution is to roll the dice. Roll the dice and see what happens. But regardless of which way they go, every one of those answers to this problem, which is they're underfunded by $300,000, falls on their shoulders. They've got to bear the burden of that. Well, what if I told you they didn't have to do any of those things? They didn't have to delay retirement. They didn't have to save more money. They didn't have to reduce their income expectations. They didn't have to take on more risk. They simply had to wait to take benefits until 70, and the impact on the capital requirement would be profound. How? Because that 18,000 that I showed you earlier, that 18,796, that we're still assuming in that scenario that they're retiring at 67. That's not up for debate. They're retiring 67 no matter what. What we're assessing here is taking benefits at 67 versus taking benefits at 70. So that 18,796 is if they turned on income at 67 and they had age 70 like benefits, right? But they can't do that, so they're going to delay. They're going to wait till 70, and thanks to inflation, that actual income gap once Social Security benefits begin isn't 18,796, is 20,515. But the gap is still considerably smaller, and the initial safe withdrawal rate is higher because, like I said, the 3 years into the plan, the capital requirement to deliver the additional income we need to add to Social Security to get them to that 108,000 is 783,000 versus $1,005,000. So clearly, purely from a math and capital perspective, delaying looks like a better option if you don't want to find yourself in the position, right, of waking up penniless. However, if you decide to delay, right, and use the later strategy, because we're still retiring at 67, just not taking benefits until 70, we have to fund the income need during this period of time. So we call the time between the age they retire and the age they take benefits the bridge period. And we calculate during the bridge period how much capital we'll have to utilize to meet their income needs and call that bridge capital. So in this case, keeping it very simple, we're going to pull 108,000, inflation adjusted at 3.1% per year for 3 years. The total value of that would be 334,148. That's going to carry us from 67 to 70. Then when the Social Security benefits begin at 70, we already know we need another 783 to deliver the additional 20,515. Add that to the Social Security, and we are at our fully inflation adjusted income goal at 70. And the total capital, bridge capital, plus the capital to close the gap is $1.1 million. So to be clear, what just happened? We took the same income goal, the same time horizon, the same portfolio construct, the same inflation assumption, the same desired probability of success. Everything is exactly the same between the earlies and the laters, with one exception: when they took benefits. And the impact is profound. They go from underfunded by $300,000 to overfunded by $82,837. And by the way, it didn't require, again, they didn't have to delay, they didn't have to save more money, they didn't have to take on more risk, right? They didn't have to do any of those things. They didn't have to get lucky. We didn't need the market to have a great return sequence. We didn't have to pick the right stock, the right bond, none of those things. Simply by leveraging all the tools in the toolbox, like Social Security, not ignoring it, the impact to the client is profound. And the last thing I'll share with you on this topic is not only did we take them from underfunded to slightly overfunded, but look at the tax efficiency. This is the piece I talked about earlier that we would cover now. By the time they're 70, whether they take benefits at 67 or 70, the total income, thanks to inflation, is over $118,000. Now, here's the projected Social Security benefit for the earlies when they hit 70. And of course, the laters is 24% more, thanks to delayed retirement credits. To get to the total income, we're going to assume, like we have all along, that the difference to get us to 118 is going to come from their 1.2 million in tax-infested IRA money. So we're taking 39,452 up from 36,000 because of inflation. Adding that to the Social Security, that gets us to 118,358. Here's the part I want to draw your attention to. On almost $79,000 of Social Security income, this is how much of the Social Security benefit is taxable. The total taxable income takes the taxable Social Security, adds it to the IRA distribution, and we have $75,121. So even the earlies are more tax efficient than anyone would have imagined. On $118,000 of income, they have $75,000 of it that's considered taxable. What about the laters? Even though they have almost $98,000 of Social Security income, only 27.6 of it is taxable. How can that be? People have no understanding of how tax efficient Social Security is. Add the taxable Social Security to the fully tax infested IRA distribution of 20,515 to close that gap, and the total taxable income when you add these two together is $48,000. So the laters have 24% more guaranteed income thanks to DRCs and 36% less taxable income before deductions. Before deductions. So how can that be? I'm going to wrap it up with this. How can that be? It can be because most people are very confused about the thresholds related to taxation of Social Security benefits. So many people are aware that there's a 50% tax, what I'll call a tax rate, and an 85% tax rate. And they may be even familiar with these thresholds. If you're a married couple, finally jointly, and you have more than $32,000 of what they think is Social Security income, then they think 50% of your benefits taxed. But that's not what it says here, right? It says up to 50%. And then they think if they have more than 44,000 of Social Security income as a married couple, finally jointly, then 85% of your benefits taxed. But again, what's happening here is these are progressive taxes. They're not flat taxes. So once you cross over these thresholds, it's not automatic that 85% is taxable or 50. It's a progressive build. Now, the biggest thing to understand is these thresholds, the 32,000 and the 44,000, they're not applied to your total income. They're not applied to your Social Security income. They're applied to your provisional income. This is this is where the magic happens, okay? Provisional income is a number you've never had to consider until you start taking Social Security benefits. And the way the IRS arrives at your provisional income value is through the provisional income formula. And the provisional income formula simply says this: take 100% of all your earned, unearned, and tax-free dividend income. Tax-free dividend income, which is not income taxable, is still countable at 100% under the provisional income formula. But Social Security, only 50% of that's countable. That's where the magic happens. So, like the laters, where they have a plan that's far more heavily weighted in Social Security, well, only 50% of that is counted on the provisional income formula, and less heavily weighted, about two-thirds of the fully taxable IRA distribution. They have 20,000 versus 39,000. It's a massive difference, all counted at 100%. What it results in are the numbers you saw earlier. Now, I can go on and on. I can get into every one of these numbers. I'm not going to do it tonight, but I'm going to come back to where I started with this, which is 24% more guaranteed income, 36% less taxable income, on top of going from underfunded to just slightly overfunded. And the $48,000 is before deductions. Now, I'm not a tax professional, but I can state a matter of fact. And a matter of fact is simply this: for 2025, if you're a married couple filing jointly, both over age 65, at a minimum, you're entitled to take your standard deduction. And the standard deduction for 2025 that you'll take when you file your return in 26 is 33.2. So think about this. If I take that 33.2 from the 48,136, my total taxable income is less than $15,000. Now apply the marginal tax rate, call it 10%, to make the math easy. And on $15,000 of taxable income, my tax liability is $1,500 or $125 a month. So to be clear, you're receiving, we'll call it $10,000 a month in total income, and you're giving back 125 in federal income tax. So there's a lot of discussion around how do we mitigate the impact of taxes. We don't know what it's going to look like in the future. There's all these gyrations you can go through. For many of us, the most simplistic and effective way to achieve the tax efficiency you seek is simply to take benefits at a different time. And again, the tools and the software, everything that Michael and team have access to, are designed to help you arrive at that solution for you. At the end of the day, if you compare and contrast the two scenarios, the earlies versus the laters, and we look at what I'll call four things: what percentage of the income goal is guaranteed? How much is inflation adjusted without market exposure? What percent is taxable? And then last, but arguably most importantly, what's the guaranteed survivor benefit look like? And the laters plan wins every time, right? We've already covered capital requirement. It won there. It wins in every one of these scenarios too on that report card. So at the end of the day, when you make a decision, you've got to consider the impact on two lives. Here's some statistics for you just to think about. I'm not going to read through every one. Ultimately, my goal when I started out was to convince you that whether or not you end up in the position you want to end up in retirement has far less to do with your ability as a saver and far more to do with the ability of the people that you work with and how specialized they are in the work that they do. Again, Michael and the team, I cannot say enough. They're true retirement income specialists. I can only say that about a handful of advisors that I know. You want to take maximum advantage of that. I know I don't want to speak for Michael, but I know the plan is to make available to everyone who's attended tonight the opportunity to come in for a complimentary consultation and let he and the team run your scenario through our retirement asset optimizer and figure out for you not only what the optimal plan is for you, but quantify the impact to the capital, to the tax efficiency, and to the survivor. So with that, if I've done my job, you agree, you recognize the value, and I'm going to kick it back to you, Michael, um, and let you take it from here. I hope that was what everybody was looking for. Thank you.
Thank you very much, Andy. Fantastic. Excellent insight. Again, the even working with Social Security for as many years, do the income plan that we do, when you see especially the tax numbers there at the end and some of those figures you put up about just how much more secure a plan can be, when you talk about some of those guaranteed sources, it really does every time still just hit home and really just again, really prove the impact of this decision. So, as Andy pointed out, it is something that we're able to do is run these things and run them for you and look at your own personal optimization. And at the end of the day, it is a matter of you just making the proper choices, and we are empowered to help you with doing that. So, again, thank you very much, Andy, for the time tonight and the great presentation. Thank you very much, Mike and Athena, also for bringing Andy to us. So, thank you all. Hope you have a good rest of your night. Take care. All right, we'll see you soon.
Thanks,
Bye.
everybody.